The reporting season, one thing we've noticed about the quality of reporting season is that the behaviour by companies in this reporting season, we're in the 9th or 10th year of an expansion. You've had a bit of pump priming out of the US. But what you're seeing is the cash conversion is actually quite poor in this part of this reporting season. So if you look at straight working capital cash conversion, it's extended from 21 days to 29 days. Now that could be good in one way because receivables are growing because of growing sales, but when you go through the data, actually they're not collecting the receivables. So that's slightly concerning that they're stretching the P&L is not really reflecting what's going on in the cash. Accruals as well, that's been building a lot of balance sheets, which is a dead giveaway for companies sort of struggling to achieve the reported numbers. And that sort of behaviour, a lot of NRI is being used, provisioning has been growing, particularly if you notice a lot of any acquisitions. There's a lot of acquisitions announced in the last couple of weeks. And you use the good old acquisition accounting rules, which is fantastic. You can change your accounts 12 months after you bought the asset. And that allows you, of course, to one of my favourites, write off all the inventory to zero cost. Just whack it in your goodwill to make it equal the acquisition price. Sell your inventory for market price, and you report an enormous cash realisation. Easy. You can do that once. So we're a little bit concerned that sort of stuff's happening right now. I've been told that when a CEO is buying stock, it's equivocal. When they're selling, it's unequivocal. To see some of the darlings of the market sort of selling, the CEO selling stock, like the CSL CEO sold straight after the result. The TWE CEO again sold another chunk of shares after selling after the first half result, where there was an active buyback on after that had completed. You put all those things together, and it looks like that we're probably stretching at the moment in the market. If you go through reporting season, of the top 15 stocks that were the best performers, the EPS upgrade was about 1.5%. So we are really in that PE expansion phase of the market. So we're a little bit concerned that in portfolios that you should be sort of looking for conservative positioning right now. And the problem is with that, some of the defensives are actually quite expensive as well. So, some of the infrastructure names, etc., they're geared right now, carrying quite a bit of financial leverage. And so they're pulling pretty hard on that, and they haven't got a lot of buffers if we have a slowing economy or traffic forecast missed by a little bit. They will tend to struggle. So if you look at reporting season in total, the only two sectors that actually had net upgrades were telcos, because I was so beaten, and steel sector. Most other sectors actually had slight downgrades. Yet the market's, pumping up against record highs. If I look at two of the themes, bear with me, that we've got a reasonable position in energy. We have overweight in oil search. We own Woodside. We own that unholy name called New Hope because it's thermal. And we own some IPL as well. So they're all sort of like related or derivative trades, particularly IPL. Now the reasons are, if you look at the chart there, you can see that you've seen a material unwind of reserves in this is integrated oil companies. And that's obviously with the oil price, when in 2015, 2016, the oil price hit $35, all activity pretty much stopped. On the right side, you can see actual exploration spending over divided by reserves. And what it tells you, that chart sloping down, is that exploration spending is falling faster than actual reserve decline. Now that will be a problem, and we've all noticed that the oil price will be quite volatile around this part of the year, but it's been robustly strong. And we're coming out of the US driving season, the Brent price, $77, $76. It's not really rolling over. And the reason is because when you think about long capital cycles, the bulks went through it 18 months ago, the iron ore price collapse, etc. They withdrew capital. Now they're all great stewards of capital again. The oil sector's probably 18 months later than that. So we're right in the middle of it. The fact that the Saudis actually haven't responded tells you something as well. I was up with another portfolio manager, and I went up to Norway and the UK, and in Norway we went there because we met a lot of the seismic companies that do all the seismic work, in particular a company called TGS, that do a lot of offshore seismic, and they were telling us that half the fleet, there's 50 seismic ships in the world that do offshore seismic, and half the fleet's out of the water, cold stack they call it, rusting in yards, and been stripped of all their equipment. And he said, 2016, they were expecting another half of the fleet to disappear, but all of a sudden it started to pick up slightly. So the IOCs, integrated oil companies, know the reserves are declining quick. And secondly, off the back of that, with the gas market, everyone's looking at shale. Everyone's expecting an LNG glut for the next couple of years. And then by luck, or it's not luck, it's bad luck, but with Fukushima happening, the Japanese pulled down their entire nuclear industry for a period. They went and bought an extra 15 to 20 million tonnes of LNG. But what actually put the fly in the ointment was the fact that the Chinese went for those environmental changes, clean skies policy, and they've been the net buyer of every LNG spot cargo in the last 18 months. And I think their target's to get to 10% of total energy use is gas. That means they have to buy, again, another 15% this year. While the Japanese, they might unwind that, but that extra 15 to 20 million tonnes, we doubt it, because they are the biggest buyer of LNG in the world. But the Chinese are catching pretty quickly. Now, because of that, I know there's 60 million tonnes in the US, and I suspect that's what most of the trade war is about. The administration is trying to get countries to buy their LNG. It is distorting markets, and one thing we picked up actually from some of the global results is because of the trade wars, a lot of the traditional logistic routes are being flipped on their heads. So you're talking about inflation in the system. Most of it is actually logistical, because we had such an efficient system with everyone running just-in-time inventory management systems. When you change the logistics, it's a cost. So that's embedded in the system. So you should assume that inflation is going to keep trailing through into everyone's results, and there's a lack of real pricing power in some of the industries. So, but with oil and gas, the gas market looks a little bit tighter. We think the glut's overstated. It's probably shorter. The market's a little bit short, and you just tell by behaviour. We know that the Chinese have been actually out of the oil market the last 2 months because the oil price has been quite strong. So with Brent strong, the Chinese are out of the market. It sort of suggests to us that the oil price and gas price is going to stay. And this sort of underinvestment takes a while to reverse. It's hard to find a new oil field. Especially if you get the price up to $80, $90, then that sort of, it probably will incent offshore exploration at this point. Another reason we went to the UK in particular is the concept of open banking. So that starts in Australia next year, in July next year. What that is, in the UK, it's pro-competition. So all of a sudden they flip the ownership of the bank's data on its head so that you own your own data. So your entire credit history, all your transactions, all your positive reporting, you make your payments all the time, you're a great credit risk, you will own that data, and you can advertise that data to another bank. Now, the biggest risk for a bank when they're trying to lure a customer over is they actually don't know much about you. Okay, they go on the bureau, the credit bureau. They can see if you've ever missed a payment, but they don't know if you're a great credit risk, which means you want to incent that person because you want them on your books because they're extremely low credit risk, and they'll probably utilise credit facilities quite well. So in open banking environment, you can claim that data back from the bank and you can send it to another bank. So in the UK, it's already happening. Now, everyone's thinking about fintechs as the way it's going to get rid of all banks. We're a little bit sceptical about that because what we've found is that banks have tremendous amounts of data, like way more than anyone else. We went to Sweden as well, which is almost a cashless society, and what we found there was they know what you're doing minute by minute. So they can actually plan and actually digitally market to your services. And under an open data world, it's called PSD2 in Europe, open data world, they have to ask for your permission every quarter. Can I still use your data? Which is a complete flip on its head. So it is coming into Australia in July next year. And for credit and debit cards and transaction accounts and mortgages a year later. Now, it is a risk to the major banks, but our work we've done on the major banks is telling us they're actually not sitting around doing nothing. Right? They are preparing themselves. Now, what we got told in the UK was from a senior banking executive was making money out of the float is over. It's just a spread business now. So, those really irritating things like you get a bank check and it takes 3 days to clear. It is cleared funds already. Both banks know they're cleared funds. but they sit on the money and they take a couple of basis points in the money market accounts and they clip the fee. That will disappear because you'll just go, well, send my data to someone else. Westpac's offering me a deal. It's equivalent to, anyway, Welsh will know this because he's old enough. When the original mobile phones that came out in the market, remember if you had to change to another operator, you lost your old mobile number, had to get a new mobile number. Until the regulators brought in mobile number portability, you were stuck on the network. So think of this a bit like that. It's effectively like mobile number portability. It makes it easier for you to shift to another bank. And banks do charge this thing called inertia margins. The fact that you lose the will to live when you try and change banks because it's so complicated. They charge a little bit more because they know they can. Under this scenario, I suspect if you're with CBA and Westpac's offering you a deal, they want all your data, Westpac will petition CBA, send us all the data, please. The next phone call will be from the CBA. So you're saying, please, you're a great customer, what can we give you? So if you've got a good 2 days, there's a Productivity Commission report that's talked about oligopolies and duopolies in Australia. Why do we have so many of them? And they do talk about this inertia. It's so difficult to move. So there's a lack of competition. So open banking starts next year. It's the major 4 banks that are affected first. Then it's utilities and telcos. And we've contacted some members from the Standard Data Board. And they informed us that you should assume this goes across every consumer-facing industry at some point in the future. Don't be surprised if it doesn't affect the big 3 tech companies as well, because they are consumer-facing and they are monetising your search history with advertisers. So that will be quite interesting. If you own that data, do they pay you for it? Does Google and those guys start paying you for your data? And you could tell that this is sort of coming, the concern for the major tech companies, because in the US, you would have seen a couple of weeks ago, Facebook went to Bank of America and JP Morgan says, why don't you give us all the transaction data of people on Facebook who are your customers? And after they were shown the door by Jamie Dimon, they were told to get stuffed because the banks know what data they have. It's really rich data. They just haven't been able to monetize it yet. So for the banks, the thing they need to do, and we are witnessing, is that they need to digitize the operations. So there's a lot of double handling within a bank, mortgage processing, all that stuff. That has to be digitized. That will lower their costs. So maybe the income line might be under a bit of pressure, but I think the banks will remove a lot of costs to offset that. So that's starting next year. It's going to have we think probably a slow start, but it will build momentum. It'll change the way things operate. It's not just domestically, it's internationally as well.